Hi, my name is Ian McGuire. This is my mortgage financing report for our B428 class, Real Estate Management. Um, I was assigned mortgage financing, obviously, so let's get started. There are actually 5 types of mortgage loans: conventional, jumbo, government insured, fixed rate, and adjustable rate. I was actually very interested to find out that there were 5 types. I had no idea that there were so many different ways to get a loan, and that there were so many different interest rates that are charged, and that they're also different from each other, and that they really do accommodate to every kind of person and every type of money situation. So conventional mortgages, they are not insured by the federal government, which I found very interesting because I always hear about loans being, especially student loans, being financed through the government, but it's nice that it's not run through the government, it's run through banks. Um, so in these kind of mortgages, um, you have to pay an insurance premium on them if you put less than 20% down, which is kind of a drag because you don't want to have to keep on paying something else after you're actually paying the actual mortgage. So that's kind of not fun. There are a couple pros to it. It can be used in many different ways. There are many different ways to use your conventional mortgages. The borrowing costs are low, and we can put as low as 3% down on it. So that's very nice that you don't have to put a lot down at that moment in time. At cons, you need a higher credit score, high debt to income ratio, and significant documentation. So there's a lot of things that you would need to be able to get that, and the credit score is very important because a lot of people don't have good credit. There's also conforming and non-conforming. Non-conforming is actually a jumbo mortgage as well. Conforming means that it's set between max limits. So we continue to jumbo. They're not conforming loan limits, so they're not within that limit that we learned about earlier in the conventional loans. They're more common in higher cost locations. I was thinking like on the coast in California and New York as examples. Um, the pros are you can borrow to buy in expensive locations, and the interest rates are not too bad. They're pretty competitive, so you're buying a lot in the moment, but the interest isn't too bad. And then the cons, obviously, it's a lot of a down payment, and then you obviously would need a high credit score to even back that up. Um, and then obviously the debt to income needs to be below 45%. So um, government insured mortgages, I found these interesting to learn about because I heard a little bit about them. Um, but if you're not able to get a conventional loan, those normal ones, they help you in getting one in a different way. Um, so they have laid back credit requirements, and there's not a lot of big down payment. And they both help first-time homebuyers and more than once. Um, so the cons, you have to pay mortgage premiums, which is kind of a drag. Those things can really add up. And then they have high borrowing costs, and you have to have lots of documentation. Obviously, it's the government, so you need to have a lot of that. They're ideal for low savings. So if you don't have a lot of capital to kind of back it up, a lot of money to back it up, it won't work. Fixed rate, so obviously it's kind of how it sounds. So over a 15, 20 year, 30-year period, they usually loan them out. The rate will never change. It's great for if you want a steady mortgage rate that you can pay and you're on a budget. But the cons are it will never change, and that rate will always stay the same. So that can be a negative as well. Um, and it's hard to build equity on that on your home as well. But it's great for people that are families that are moving into a house and plan on staying there for a long period of time. Adjustable, how it sounds, you can adjust the rate as you go on. The market, it will depend a lot on how the market's doing, and then but you can cap it as well, so it doesn't move too much. Um, and then you save a lot in interest payments, so that's a pro. And then, but for cons, it's harder to refi your house. My mom just did that with our house, so obviously she didn't do that because it would be harder to do. Um, but if you're a little bit comfortable with taking a risk, and then if you don't plan on staying too long for home, that's the mortgage rate for you. But that's what I learned this week about mortgage financing. Thank you for your time, and hope it was helpful.